Hello and welcome to Trusts and Estates Weekly. I'm your host, Kevin Bemmel, and we're here every Monday at 10 a.m. Pacific time. And we talk about all things related to trust and estate and probate, both from the planning side and the administration side. So whether you're someone looking for information about your own situation or you're a professional like my guest and me, this is the show for you. So today I'm very pleased to welcome Jacqueline Yu onto the show. Jacqueline and I met, I think, almost a year ago now. And she has such a busy schedule that I wasn't able to book her until now, but really excited to have her on the show. She has very, very deep as well as broad knowledge in this subject. And so without a lot of ado, because I'll have I want to have Jacqueline speak. First of all, thank you so much for coming on the show today, Jacqueline.
Thanks for having me. Thank you, Kevin.
You're welcome. So start out, if you would, just give us a little bit about your background so people can understand, the work that you do and your level of expertise and experience.
Sure. So I run my own practice, the law offices of Jacqueline D.U., and I have offices in Beverly Hills and Calabasas. I've been practicing for over 16 years now, purely in estate planning and trust administrations. I also have a Master's of Law and Tax from UCLA, so go Bruins. Um,
Okay.
Juris Doctorate from Notre Dame Law School, so
Wow.
I am a definitely a hopefully not an enemy of Trojans. So hopefully none of your listeners are USC alumni, but I digress.
So just full disclosure, I am a USC graduate.
Right. That's what I
One of
figured.
my longest standing friends was a USC grad, but a professor at UCLA for 30 years. So we work both sides of the town.
Well, you're very gracious for inviting me, regardless of being a Trojan. So thank you.
Well done. So you know, being that your practice is Beverly Hills based and Beverly Hills and Calabasas based, to candidly of the most affluent communities right here in the greater Los Angeles area, I imagine you encounter complex planning and administration situations quite often.
Mhm,
And in preparation for the show, you mentioned you wanted to talk about a couple of them, something called a slat and an injit. Uh,
mhm.
and so I'm going to sort of take a step back and kind of let you set the stage for these and talk about how they work and how they can help people, with who have more complex, undoubtedly larger estates.
And more so, we will expect to have people um, crossing over the exemption threshold come December 31st, 2025, right, when the exemption will be significantly reduced by half. So there will be more people who will be in need of these advanced estate planning strategies. So it's really important that we do discuss this because it will be hopefully helpful to a lot of your viewers and listeners and a lot of people in general,
Mhm.
especially living in California where it's quite easily be able to cross over that exemption threshold. Um,
I'm
with
sorry, I'm going to interject here just real quickly for folks who don't know what we're talking about.
Mhm,
Right now, the exemption from estate taxes is approximately $13 million. And if
correct.
it's a married couple, it'll actually be double that.
Hmm.
However, assuming that the law, the 2017 tax law, expires as planned,
Hmm.
at the end of 2025, that exemption is going to be cut. I've heard various estimates of what it's going to end up being, but somewhere to around maybe
Six
about
or
6 or
seven.
$7 million. So
Right. Right.
again, for an individual, about $6 to $7 million. For a married couple, maybe 12 to 14. But still, that's a huge reduction and is likely to um, uh, catch a lot more people, especially here in the coastal parts of Southern California than the current law. So
That's absolutely correct. So, under the 2017 Tax Cuts and Jobs Act, um, we currently have the highest exemption in history, which is 13.61 million per person. So, for a married couple, that's double that, as you mentioned. That's 27.22 million per married couple. But this is scheduled to sunset by statute. So, it's already
mhm,
written into law
right.
December 31st, 2025, to roughly 6 or 7 million per person. So that's about 12 to 14 million, as you mentioned, per married couple, December 31st, 2025. So we're looking at two different um, playing fields, one
Mhm,
that we currently have now and one that will happen at the end of next year.
right.
So, what do? The general rule is to try to have an estate plan that is flexible, that we can use depending on these circumstances and changes in the tax laws. And so, what I have been helping my clients with from now until end of next year, especially those who are close to the threshold under the current tax exemption, estate tax exemption, and
Mhm,
who will be most certainly after the end of next year, and how to maximize on their current exemption amount. Fortunately, the IRS has issued regulations that make it very clear that if you maximize on your current estate and gift tax exemption today, which is 13.6 million, and it goes down to 6 or 7 million at the end of 2025, they won't go back and try to assess the amount that you've gifted in excess of that exemption by the
oh,
end of next year. So we call this a anti-clawback regulation, and that's already set. So that's kind of our safe harbor. So we have the go signal, the green light to say, okay, great, we have this exemption within this window period. Let's use it if we know we're going to have a taxable estate.
okay.
And so, with that said, we have that safe harbor. I want to talk about really the two main um, trust strategies that I've been using, and a lot of other advanced estate planners have been using, particularly in California, to be able to maximize on the higher exemption amount. And the first is the spousal lifetime access trust, and the second is the intentionally defective grantor trust. Unlike in other states where you could set up what we call a self settle trust, like Nevada or Delaware, where you, as the grantor, sets up a trust and you could be one of the beneficiaries, and that still provides asset protection. And it also excludes the assets you've transferred from estate inclusion. Here in California, we don't have the benefit of utilizing the asset protection feature of self settled trusts.
Mm,
What we often use instead, and this goes for married couples, is the spousal lifetime access trust. So, if you, to a certain extent, if you want to have your cake and eat it too, where you want to maximize it in your exemption, put it into an irrevocable trust to reduce your taxable estate, but you may want to still benefit from some of the assets you've gifted away. We use the spousal lifetime access trusts. And it's an indirect benefit. It doesn't mean that you are legally entitled to the assets in that trust you've given away, but by virtue of still staying married, so it's important that you still stay married, you can indirectly benefit from the assets you've gifted uh, to this irrevocable trust for the benefit of your spouse, whom we call the beneficiary spouse. So, if you're married, you are the grantor spouse. You're the one who's setting up this trust. You can set up an irrevocable trust for the benefit of your spouse being the beneficiary of that trust. And it could be for his or her lifetime.
mhm,
And upon his or her death, upon the beneficiary spouse's death, it gets distributed out to generally the children or more remote descendants into often what we structure as dynasty trusts, which I'll go over a little bit later as well. But in California, there's no such thing as a pure dynasty trust because we have a thing called the rule against perpetuities here in California. And technically speaking, the trust will terminate. within 90 years from the death of the last beneficiary who was alive when you created the trust. So it's not a complete perpetual trust that you may benefit from in, say, Delaware or Nevada, but at least it's a pretty long time they could keep this trust.
Hmm.
So that is kind of the big picture of spousal lifetime access trust. We call them SLATs for short. And here's some of the requirements for setting up a spousal lifetime access trust. Number one, whatever you transfer into that trust must be your separate property. So we would have to transmute or change the character of that property from community to separate property before funding those assets into a spousal lifetime access trust. The reason for that is because your spouse is the beneficiary of that trust, you
Hmm.
don't want to have your spouse having an interest or ownership of that asset you've gifted away. Otherwise, we're risking inclusion of the assets you've gifted into the beneficiary's spouse's estate.
Right.
Right. So it defeats the entire purpose of trying to exclude these assets, not just from the grantor spouse's estate, but also the beneficiary spouse's estate. So, number one, we want to make sure the assets transferred to the SLAT is the grantor spouse's separate property.
Hmm. I'm going to interject a question here real quickly. So
Sure.
it sounds like the SLAT, unlike a typical trust that a married couple might set up, an inter vivos trust, which usually is revocable at least until the death of one of the spouses. So it sounds like the SLAT is irrevocable from the get go, or
From the
from the
get go.
funding of the trust, right? And
Right.
so that way it creates, in essence, a separate estate from both of the spouses.
Correct. And it's a separate trust. It has a separate taxpayer ID. It files a separate tax return. But so long as the grantor spouse is alive,
Hmm.
it doesn't necessarily need to pay its own income tax, the SLAT, because it's a grantor trust. So what that means is any income earned by the assets transferred to the SLAT
Hmm.
will flow through to the grantor spouse's individual tax return.
Oh, okay. So so it would it file essentially an informational return, not unlike an LLC or something like that?
Well, it depends on the CPA you work with, but my general practice is yes, you would file a separate return, even though it's not reporting any income, and it
Hmm.
issues a K-1 from the trust return, which is a Form 1041, California 541. It issues a K-1 to the grantor spouse, and all the income of the trust is reported on the grantor spouse's individual 1040.
And
And
can the
that's the
grantor?
cleaner way. That's the cleaner way of doing
Okay,
it.
yeah, yeah, and that makes sense. Can the grantor also be the trustee,
No,
or is because it's irrevocable, right? Or because it's
correct.
revocable. Sorry, because
It's
it's irrevocable, he can't be the
right,
trustee, right?
right.
So
So
you'd have to have a
a,
third
s-
party
a
trustee.
third party trustee. So the second requirement is the grantor spouse cannot be the trustee of that trust. Otherwise, it will be whatever you've gifted into this trust will be included back into the grantor spouse's
Right,
estate because they have the full power to manage the trust. So
right.
we want to keep it completely out of the grantor spouse's estate. In order to do that, we need to have an independent third party trustee to be able to exercise what we call the discretionary distribution powers
Mhm,
of the trust. So that means the power to make distributions beyond health, education, maintenance, and support, which under IRS terms, that's what we call an ascertainable standard.
mhm,
So the power to terminate, the power to distribute a significant portion of the trust, the power to change the situs of administration of the trust, the power to even amend on limited circumstances the trust. It needs to be held by a third party independent trustee.
mhm,
Who would qualify as a third party independent trustee? And under IRS Code Section 672C, that independent trustee cannot be any of these people in the following categories: the grantor's spouse, the grantor's children, the grantor's siblings, parents, employee, or agent. So as long as they don't fall under any of these categories,
Mm-hmm.
then they would qualify as an independent third party trustee. Having said that, the beneficiary spouse can also be a co trustee. They
Oh.
can serve alongside the independent third party trustee, but the beneficiary spouse is limited in the powers he or she may exercise. And that would be the power to distribute only for an ascertainable standard, which would be health, education, maintenance, and support. So, for instance, if the beneficiary spouse needs some funds to pay her medical bills,
Hmm.
then he or she can exercise that power without having an independent trustee to make that distribution.
Okay. Now, if the independent, I assume the independent trustee can confer with the grantor, but at the same time, if the independent trustee seems to be always doing what the grantor wants, it would seem like there's a danger, right? Would you
Right,
talk a little bit about that aspect of it so people can get a feel for that? Because I know in I often talk about how, for example, when I'm appointed as the trustee or the administrator of a estate, I'll talk to the beneficiaries, even
mhm,
though they can't dictate to me. I still want to talk to them to understand, what their perspective is as part of my overall decision making process.
right.
So in this case, we have the grantor who's alive. Presumably, the trust is being administrated in accordance with that grantor's wishes to a certain extent. So,
Right.
what are
And
kind of the guidelines there?
and those are wishes, right? So it's
Hmm.
precatory. It's not mandated. And we can, say in the trust, it's the grantor's wish that the assets of this trust would be for the purposes of providing for the grantor's spouse um, and to provide for his or her needs. And it goes to, under the terms of the trust, it goes to the children, more remote descendants, or that it's the grantor's wish um, that other resources outside of the trust first be taken into consideration before the independent third party trustee makes discretionary distributions
Hmm.
beyond health, education, maintenance, and support. But again, it's precatory. So the big takeaway here is that the grantor spouse cannot dictate to the trust independent trustee or the beneficiary spouse who's acting as a co-trustee what to do with those trust assets.
Hmm.
You can spell out certain guidelines in the trust, but that's it. Um, where and ultimately, as you know, with a trustee, their fiduciary duties lie with the beneficiaries.
Hmm.
And so the trustee can ask what the needs are and ask what the concerns are from the beneficiary spouse. And if upon the beneficiary spouse's death, then the children who will ultimately become the remainder beneficiaries.
Hmm.
But the biggest thing is yes, the grantor spouse cannot tell and dictate what the trustee can or cannot do because they have the discretionary powers. Otherwise, it will risk bringing back into the grantor's estate the assets that he or she has gifted away.
Hmm. Makes sense. And um, okay, I'm sorry. Why don't you go ahead? I'm going to reserve that question because
Sure.
you may be planning to answer it down the road.
Sure, and the other thing to consider, or not consider, but a requirement for SLAT to avoid the inclusion of these assets you've transferred over in not just the grantor spouse's estate, but also the beneficiary spouse's estate, is to avoid or to make sure you draft the trust agreement. If, let's say, each spouse created a trust for the other, a
Hmm.
spousal lifetime access trust for each other, that you do not. Um, fall into the reciprocal trust doctrine. And what that means is you can't have the terms of each trust exactly mirror each other.
Oh, okay. Uh-huh.
Otherwise, the IRS will say this is a whole sham. I mean, basically, you're just creating a trust for each other so that you can still access the funds that you've transferred to your spouse.
Right.
They're exactly the same. So, one of the ways to avoid the application of the reciprocal trust doctrine is maybe creating the slat for each other in different times.
Mm.
But if that's not possible because you're rushing to meet the deadline before end of next year, okay, fine. You create them, close in time, but you make sure that the terms of distribution are different. Maybe you want to give one beneficiary spouse a limited power of appointment to maybe uh, determine which of the children, which of the descendants receive the assets when he or she passes. And then on the other trust, there's no limited power of appointment. Those are now two different trust terms.
Mm-hmm.
Or perhaps give a different type of distribution where one trust is purely discretionary with no ascertainable standards. So that would mean the beneficiary spouse cannot act as co trustee. But on the other trust, maybe you want to give an ascertainable standard. But in that case, it's more uneven that way, where one spouse can act as co trustee, the other trust, that beneficiary spouse cannot act as a co trustee.
Mm-hmm. And would you be well advised to also have different independent trustees, or would that not matter?
Um, in terms of who would one should consider as an independent trustee,
Right.
or
In other words, you're the third party trustee.
Mhm.
Should those be different if there's sort of mutual slats, or would that not matter?
It wouldn't matter. It
Okay.
wouldn't matter because an independent third party trustee has his own fiduciary duties, and it's going to be different under each trust, right?
Okay.
Because
Right.
it's a different beneficiary spouse under each trust. So that wouldn't matter. And it also saves administrative costs of having two different professional fiduciaries, for instance, or a family member who's outside of that 672C limitation. Um, so it does make it a little bit easier to use the same independent third party trustee.
Mhm. And so this, and you, I think you partially answered this question, but um, oftentimes I assume the sort of final beneficiary or the remainder beneficiary of the slat is going to be the couple's children.
Hmm.
Um, what happens if the children are minors at the time they, the parents uh, die?
Hmm. And that's a good segue into well, limited dynasty trust. I would say under California law, but it or we would call it GST trusts, where um, the beauty of a slat that would form into a GST trust is now the assets continue to be transferred tax estate and gift tax free, not
Mm,
just during the spouse's lifetime, but once it goes to the children and then to the grandchildren and then the great grandchildren, it is also free from estate and gift tax, and it's also free from generation skipping transfer tax. And so the generation skipping transfer tax, just if anyone listening is not familiar with it, there's an additional layer of transfer tax when there is a transfer to a beneficiary who is at least two generations below the grantor's spouse in this case, or 37 and a half years younger.
mm, okay.
And so what you can do is when you initially fund a spousal lifetime access trust, you not only allocate your higher estate and gift tax exemption, you can also allocate an equal amount of generation skipping transfer tax exemption. So each person has the same amount, 13.61 million of GST exemption that they can allocate into a slat, which would then go into a GST dynasty trust. And for minor children, it's a perfect vehicle because if both parents pass, then, or even after the passing of the beneficiary spouse, it's important to take note that once the beneficiary spouse dies,
Mhm.
the grantor spouse no longer has access to the assets he's given away.
Right.
It
Right.
will go straight to the children, and it can go outright free of trust or stay in these GST dynasty trusts for the descendants. And as long as the children are limited in their access to the trust, so we can limit it by an ascertainable standard like health, education, maintenance, and support, it's also outside of their estates.
Mm, gotcha. Now, and I know we were going to talk about the Injit, but
Right.
we're going to come up on our time, so we'll have to reschedule you, I think, to talk about that, because I have another question about the
Mhm.
slats, and that is, let's take a very high net worth couple who's let's say, um, their combined wealth is maybe 5 times the current exemption. So they're, they have a net worth of maybe $70 million, right? So even if they have their own exemption, they set up a slat for each other, that won't prevent part of
Hmm.
their wealth, right, from being subject to estate tax. So
Right.
could they set up multiple slats?
Uh, no. So once you have maximized on your exemption, let's say they've maximized their 13.6 million for one slat. Now they no longer have any other exemption left to use. Well, perhaps they can create a trust, but in that case, we're not going to be using the exemption anymore. They can create a different kind of trust for the benefit of the beneficiary spouse. But in that case, when we transfer the assets, instead of filing a gift tax return, because then it would be a taxable transfer, right? We
Mhm.
can structure a sale.
Oh, okay.
So it would then we would create well, we're going to talk about idiots, but here's a good time. We can create an intentionally defective grantor trust where we could name the beneficiary, one of the beneficiaries, or the sole beneficiary, the spouse.
Hmm.
But in this case, because we don't have any exemption to use anymore for the gifting, we can transfer the additional assets by structuring a sale, assuming that there's enough cash to seed fund that IJIT before
Hmm.
the sale is structured.
Hmm.
And the sale could be structured on an installment note. So it would be a way to pay off that note through assuming that the assets that were transferred is income producing,
Hmm.
that there would be enough to service that note.
And so they would end up paying either capital gains taxes or uh, regular
Ordinary
taxes,
income.
ordinary income taxes, yeah, on the proceeds of that sale. But if it's an installment sale, that could be over time.
Well, the beauty of an intentionally defective grantor trust, and thanks for that segue, is that selling to an IJIT, it will not trigger a capital gains tax.
Oh,
Because an IJIT, just to shorten the definition of an IJIT, it is a complete transfer for estate tax purposes, so it's a completed gift. But for income tax purposes, the grantor spouse remains the one responsible for paying the income tax. So
oh,
essentially, if you sell to an IJIT, you're basically selling to yourself. And if you're selling to yourself, it will not trigger a capital gain.
wow, wow, very, very, very clever.
Very clever. But
Yeah.
those are kind of some of the other strategies we can consider, especially if you have a married couple who uh, exceedingly exceeds the exemption, and
Mhm.
there's going to be a taxable estate even after you've whittled down their estate value.
Mhm. And just trying to think, I guess it wouldn't necessarily make sense to do multiple idiots because you're not taking advantage of a gift tax exemption at that point. You're
Right. And it could be the case that you may create an IDGIT for the spouse, and then when the spouse dies, it goes to the beneficiaries, like the children, the remainder beneficiaries.
Mhm.
You can also set up a direct gift trust and another IDGIT just for the children.
Hmm.
And if you have a business interest, by setting up different trusts, you can take advantage of fractional discounts. And so instead
Oh,
of using
mhm.
well, if you, regardless if it's a sale or a gift, the benefit of using fractional discounts, lack of marketability, lack of control discounts, is the value of the asset that's being transferred will be reduced. So for gift purposes, you're preserving more of your exemption. On the sale side of it, because there are different beneficiaries and the different trusts you've created, then the fair market value that will be purchased by the trusts will be discounted.
Gotcha. And so let's one other aspect I would like you to address is once you start having multiple trusts, that will create a situation where you have costs of administration. You mentioned it just briefly a little while ago.
Mhm.
What can people expect in terms of cost of administration for, these various types of trusts? Is it
That's a
usually?
very good question. And you have to balance it out of how much administrative costs and maintenance do you want to deal with versus the estate tax savings that of 40% above the exemption that you're saving, right?
Right.
So the administrative costs to consider, one, having a third party independent trustee for these trusts.
Mhm.
So unless the trustee is willing to waive, great. If it's a trusted, good family member who's kind enough to serve, then great. But they're not going to live forever. So who's
Mhm.
going to take over after that family member passes away or can no longer act? There's also the filing of tax returns for each of these trusts. So for each trust, you're going to have to file 1041, which is the federal fiduciary return, the California 541, the state fiduciary return.
Mhm.
The trustee will need to have an accounting
Mhm.
for the beneficiaries, so at least annually. So
Mhm.
these are the administrative costs that you will have to take into consideration when setting up these trusts, because you no longer own it. It's owned by a separate trust, a separate taxpayer ID. It will
Mhm.
have its own maintenance costs.
Right. So if it were, let's say it were real estate. So if you had a property management company anyway, now the trust would bear that cost rather than you bearing it. So that wouldn't really change, but it
Right.
would be the sort of more top level administrative costs
That's
um,
correct.
that are
That's
going on.
correct.
Right.
And you also have to consider and make sure you work with the other advisors of the grantor spouse or the married couple, like their CPA and their financial advisor, because as an estate planning lawyer, I can only see what information the clients have given me, but I need to work very closely with their CPA, their financial advisor, to
Hmm.
see the overall picture, their financial makeup, the cash flow that's entwined with the assets that we're transferring into these trusts.
Right.
Because if that asset is not going to generate sufficient cash flow, we're in trouble.
Right. Right.
Why? Because when the grantor dies, it becomes a non grantor trust. Now, the trust is responsible for paying the income, or if it goes down to the beneficiaries, they're going to be responsible for the income. We want to make sure if it's at the trust level, there's enough income generated to pay for those taxes and those administrative costs.
Right, right. And assuming, staying with the real estate just for a minute, let's say there are multiple pieces of real estate put in the slat. So um, the slat basically, how does that work from a liability standpoint? Let's say, there's a slip and fall in one of the buildings. Does that put all the assets at risk? Or, will it just be, um, you know, I mean, will it put all the assets in the trust at risk, or could that possibly spill over into other assets that are
Mhm.
owned by the grantor outside of the trust? How does that work?
Sure. So by transferring your asset into an irrevocable trust and without having retaining any interest in those assets um, after it's been transferred, then it is a creditor protection, right? So if there's a slip and fall in that real property that's now owned by an irrevocable trust, they can only reach the assets that are in that irrevocable trust. They can't go after the grantor spouse's personal assets, their family home, and so forth. But even further, if you have that real property in an LLC or a family
Mhm.
limited partnership, then there's an added layer of protection, because now if there's a slip and fall in that real property that's owned by that entity, the only thing that creditor can go after is whatever's in that entity.
Okay, that
And
was going to be my next question.
right.
Was right,
And we want to make sure the first layer of defense is you want to make sure there's enough insurance coverage,
of course.
liability insurance coverage for the property that you own that's being rented out. So that's the first level of
Mhm.
defense.
Gotcha. Well, you know what? We've gone a little bit over time, but so much great information here that actually I could keep talking to you for another hour, I'm sure. But I know we both
Likewise.
right, we both have other things we have to do today. So I want to thank you so much, Jacqueline, for coming on the show. I know people are going to find this very, very interesting and useful. And again, especially as we head into next year and the uncertainty about what's going to happen with the 2017 tax law. This is really something I did a show a few weeks ago where I started encouraging people really start talking to your advisors about this now. It may seem like it's far away, over a year away, but that's not a whole lot of time to
Mhm.
figure these kind of things out. So, for those of you who are watching or listening, if you potentially fall into a situation where you're going to have to pay estate taxes, now's the time to plan. I'm dealing with a situation right now where the fellow died intestate, large estate. About a third of the state is being lost to estate taxes.
Oh, wow.
It's just tremendous loss to his heirs. Not that they're not getting a big pot of
Mhm.
money, they are, but it's we're talking big figures here. So it's really a shame that unfortunately he didn't do proper planning. So, Jacqueline, I'll put your contact information in the show notes. So
Thank you.
if anybody, if you would like to get in touch with Jacqueline, her email address and her website will be there, and I'm sure Jacqueline would be happy to speak with you about whatever questions you have in this and other arenas of estate planning. So please don't hesitate to reach out for her. So give me a minute here. I'm going to wrap up the show and then we'll go offline and talk for a minute. So, folks, thank you so much for watching today. I'm not even going to say I hope you found this informative. You had to have found this informative. Jacqueline is just brilliant with these kinds of concepts and the clarity with which she passed over the information. So thank you so much for watching. Real quickly, tomorrow at 10 a.m. Pacific time, Tuesday, is my show, Business Lessons from the Military. And my topic is put a dog on your team. So I'm going to talk about dogs in the military. For all of you dog lovers out there, this is your show. But I think you will find it really quite fascinating, the history of dogs in the military. And then on Wednesday at 10 a.m. is my show, People Making Money. And my guest is going to be David Daly. David is a Marine Corps veteran and drone pilot. And he's going to talk about flying with his feet on the ground. That's the basis on which he built his business. So David is really kind of at the cutting edge of technology and what he's doing with drones. And so I invite you to tune in for that. And then on Thursday, this is my every other week show at 5 p.m. Pacific time, Jiggers' Place. We'll sit back toward the end of the week, have a cocktail, and talk about the existential question, right? Faith versus reason. What should we be doing about that? And this is I think this question is probably millennia old, and it is best discussed over a cocktail. And the cocktail for this week is the Divine Logic cocktail. So you'll have to tune in to find out what that is. But this is a time for us to, as I said, toward the end of the week, relax, talk about all those other things in life besides our business and professions. So I invite you to join me. And then a week from today, we'll be back for the next episode of Trust and Estates Weekly. So once again, thank you so much, Jacqueline, for being on the show today. Can't tell you how much I appreciate it.
It's
And
my
signing
pleasure.
off as I always do, Marie, darling, you are my bell. Courage at all times, my friends.
Thank you so much, Kevin.